You swipe your card. A coffee appears. And somewhere, money is created out of thin air. Not transferred, not moved, created. Most people think money already exists, sitting in a vault, waiting to be handed over digitally. That's comforting. It's also wrong. And right now, with inflation, debt, and interest rates dominating headlines, this misunderstanding matters more than ever, because the truth is uncomfortable. Let's slow it down. You walk into a cafe. You tap your card for $5. It feels instant, clean, final. But behind that tap, no pile of money was reduced. No vault lost $5. Instead, your bank typed a number into existence. Here's what actually happens. Your bank looks at you and says, "We trust you." Not fully, just enough. It creates a deposit in your account and a matching debt on its balance sheet. 2 entries, same amount. That's it. No government printer, no central bank employee pressing a button for your latte. Your commercial bank just created new money. This is not a loophole. This is the system. In most modern economies, over 90% of all money is created this way. Not by governments, not by central banks, by banks, every day, quietly. This matters because money feels like a thing, but it's really a promise that you can pay later, a promise that others will accept that promise, and the entire system runs on that trust holding together. Here's the part no one explains clearly. Banks don't lend out existing money. They create money by lending. When you get a loan, the money doesn't come from someone else's savings. It comes from a keystroke. The savings show up after. That sounds backwards, because it is. And it works as long as people believe the promises are solid. Now zoom out. Every swipe, every loan, every mortgage, they stack. More money exists because more debt exists. This is where the irony kicks in. We're told money is scarce, budgets are tight, resources are limited. But money itself expands when borrowing expands. The real limit isn't paper or digits, it's confidence. Confidence that debts will be paid. Confidence that banks won't panic. Confidence that tomorrow looks enough like today. When that confidence cracks, the magic reverses. Loans stop. Money disappears. Not slowly, instantly. That's what a financial crisis really is. Not a crash of prices, a collapse of trust. And here's the quiet risk. The more money is created through debt, the more fragile the system becomes. Growth needs more borrowing. Stability needs restraint. Those don't get along. So when you swipe your card, remember this. You're not just buying coffee. You're participating in a global trust experiment built on promises, balance sheets, and belief. And the uncomfortable question isn't who creates money, it's this: what happens when fewer people believe in it?